before making any financial decisions. Welcome to this video on the Silicon Valley Bank failure case study. In this video, we will delve into the details of what caused the failure of the Silicon Valley Bank, its impact on the financial industry, and the lessons that we can learn from it. Silicon Valley Bank was founded in 1983 and is headquartered in Santa Clara, California. It was created to provide banking services to technology and life science companies in Silicon Valley. The bank grew quickly, and by 2014, it had over $30 billion in assets under management. However, in 2016, the bank began to experience financial difficulties, which ultimately led to its failure. What caused the failure of Silicon Valley Bank? The failure of Silicon Valley Bank was caused by a number of factors, including mismanagement, inadequate risk management, and a lack of oversight from regulators. One of the main reasons for the failure of the bank was its over-reliance on lending to the technology and life science industries. These industries are known for their high levels of volatility, and the bank's loan portfolio was heavily concentrated in these sectors. As a result, when these industries experienced downturns, the bank's loan portfolio was hit hard, and the bank was unable to recover. Another factor that contributed to the bank's failure was its lack of adequate risk management. The bank did not have a comprehensive risk management system in place, and it did not properly assess the risks associated with its loan portfolio. This lack of risk management made it difficult for the bank to manage its loans effectively and mitigate potential losses. The bank's mismanagement also played a role in its failure. The bank's executives were focused on expanding the bank's loan portfolio and increasing its profits, but they did not properly manage the risks associated with this growth. This led to the bank taking on more risk than it could handle, and ultimately led to its downfall. Finally, the bank's failure was also due to a lack of oversight from regulators. Regulators did not adequately monitor the bank's activities, and they did not take action to prevent the bank's failure. This lack of oversight allowed the bank to continue to operate even as it faced financial difficulties. The impact of Silicon Valley Bank's failure. The failure of Silicon Valley Bank had a significant impact on the financial industry. It led to a loss of confidence in the banking sector and caused many investors to withdraw their funds from other banks. This led to a credit crunch, which made it difficult for companies to access the capital they needed to grow and expand. The failure of Silicon Valley Bank also led to a loss of jobs in the banking industry. Many of the bank's employees were laid off, and other banks that were affected by the credit crunch also had to lay off workers. Additionally, the failure of Silicon Valley Bank had a ripple effect on the technology and life science industries. These industries relied heavily on the bank for funding, and when the bank failed, many companies in these sectors were unable to access the capital they needed to continue to operate. This led to a slowdown in innovation and development in these industries. Lessons learned from Silicon Valley Bank's failure. There are several lessons that we can learn from the failure of Silicon Valley Bank. One of the most important lessons is the importance of risk management. Banks must have comprehensive risk management systems in place to properly assess the risks associated with their loan portfolios and manage these risks effectively. Another lesson is the importance of diversification. Banks must not rely too heavily on any one sector or industry for their lending activities. Instead, they must diversify their loan portfolios to minimize the risks associated with any one industry. Finally, the failure of Silicon Valley Bank highlights the importance of regulatory oversight. Regulators must monitor banks closely to ensure that they are operating in a safe and sound manner and taking appropriate actions when necessary to prevent failures. This oversight can help prevent future failures and protect consumers and investors. Conclusion. In conclusion, the failure of Silicon Valley Bank serves as a cautionary tale for the financial industry. The over-reliance on lending to a single industry, inadequate risk management, and lack of regulatory oversight can all contribute to the failure of a bank. As we move forward, it is important that banks learn from the mistakes of Silicon Valley Bank and take steps to ensure that they are operating in a safe and sound manner. By doing so, we can help prevent future failures and protect the stability of the financial system. Thank you for watching this video on the Silicon Valley Bank failure case study. Thanks for watching.